Let's also look at the consolidated statement of changes in equity. And please note, this is for the year ended 31 December 20X9, which is the year of acquisition. Just a few things I want to point out. Your non-controlling interests cannot have an opening balance. The business combination happened during the current reporting period. So your non-controlling interests only originated for the first time during this year. There wasn't a group last year yet, so there's no closing balances for NCI that can transfer to an opening balance. So the amounts that you've measured NCI at acquisition date will be included in the NCI column, but next to a brand new line item that you haven't seen before. Acquisition of interest in subsidiary, and that 120,000 Rand comprises of your two at acquisition date measurements, the 65,000 for the ordinary share NCI and the 55,000 Rand for the preference share NCI. Profit attributable to NCI, we've calculated and looked at that when we did the Splocky, and there was also two consolidation journal entries for that amount. When I looked at the journal entry, I told you that is the combined profit that you'll see on the Splocky and then also in the statement of changes in equity. In journal 4 and 5, we deal with the intragroup dividend declared by the subsidiary. These two amounts gives effect to those debit legs of those two elimination journal entries where we change the NCI balance with the negative movement as a result of the dividend declared to them. Your ordinary share capital is always only that of the parent, not because it's a recipe, but because we apply a principle. In the retained earnings column, you should now try and understand what should be included in your opening balance. The group only formed this year. What happened to that opening retained earnings of the subsidiary, the 7,500? It got eliminated. And there's no other retained earnings that I can include as an opening balance that was earned by the subsidiary since acquisition date yet. So that opening balance will be that of the parent plus that of the subsidiary, but the effect of journal 1 is that the 7,500 got eliminated. Next to profit for the year, this represents the profit of the group attributable to the owners of the parent. This amount you can pick up from the consolidated Splocky, and there's also a calculation down at the bottom that you can refer to. Then dividends are always only that of the parent, not because we have a little recipe, but because we apply a principle. We do add the subsidiary's dividends declared, but then the effect of that consolidation journal entry is to eliminate the dividend declared by the subsidiary. You would have picked up how important it is that you are able to see how your consolidation journal entries are changing the line items. Every time you see that little J reference, as I've said before, please go to the journal, see what you did in the journal, and then understand the effect it has on the line item. To wrap up example 9.1, let's talk about the analysis of equity. And I want to show you how all the amounts you've already calculated will fit into the analysis of equity when you have an interim acquisition. The share capital is still there, the investment by P is still there, and NCI, all the same. When you refer back to your allocation of items calculation that we did, we identified the retained earnings at acquisition date attributable to the ordinary shareholders to be the 51,800. So in the analysis, just put in that one amount. Don't bother to put all those individual income and expense items in the analysis. You have it in your calculation, and you can then from that calculation use it to prepare your at acquisition consolidation journal entry. Then in a current year acquisition, You will not have a since to opening balance yet. You will only have a current reporting period. And this is where we now start with the profit since acquisition date. That's allowed to be in the group. And we exclude from that the portion attributable to the preference shareholders. In the following reporting period, everything will be back to normal. Then in since to opening balance, you'll start with the opening retained earnings of S. You will deduct this at acquisition date retained earnings, and you will keep on with the attributing to parent and NCI like you've always done. So it's really just affecting you in the year of acquisition, but this at acquisition section and these amounts are very important because this will now always be your at acquisition amounts. And what do you calculate here? You measure NCI and you calculate something like goodwill. So if you got that amount wrong, the at acquisition retained earnings, you're going to end up having incorrect goodwill or gain from bargain purchase going forward. In the preference shares analysis, at acquisition date, there's the share capital, the investment, and the NCI. And now you can see that we've moved that 2,500 from the retained earnings total at acquisition date of the subsidiary to the preference shares, as that's the portion they are entitled to as the preference dividend accumulates over time. Again, no since to opening balance period, only a current year reporting period section, and this is now where you see the 7,500. So now you can see that we have attributed the 2,500 and the 7,500 to the preference shares, and then the preference dividend got declared being the full 10,000 Rand.